be focusing on the liquidity ratio. I think we'll touch like three aspects of our liquidity ratio, which is the sorry, I mentioned I just like explained the current ratio on my previous video. You can just go to it and watch the current ratio being explained. So liquidity, like it means like how do businesses know if they can pay their bills, collect from customers, or manage inventory efficiently. Like in easy ways, it means the ability of a business to settle its short-term commitments. So that is our liquidity ratio. So briefly state, that's where the financial ratios come in. Like they help measure liquidity, efficiency, and solvency. And I also explained the solvency ratio on my other video. So we have 6 ratios to refer to when they ask you about liquidity. So if they say comment on the liquidity ratio, you just like have to look at your 6 ratios. But here I'm just explaining 3 of the ratios. I explained the other ratios on my other videos. So first of all, we have our debtors collection period. So it means the number of days it takes us to collect the number of days it takes us to collect our cash from our customers or our debtors. So the formula is given by the average debtors over credit sales multiplied by 365 over 1, or just 365 days. So I'll show you how to calculate the average debtors. So this, like, it must not take too long or too many days for us to collect our money from our customers. You don't like it if you collect money after like 200 days or 3 months. That's a bad thing. So it must take you maybe 1 month just to collect your money from your debtors. So let's do this example. Let's say we have like our financial years 2024 and 2025. Then we have our trade debtors, which means our debtors. Then we have like the amounts here in rands. We have 60,000 here, we have 50,000 here. Then we have our credit sales amounting to 650k. So this is the calculation. Then the question comes and says like calculate the debtors collection period. So you write down the formula average debtors over credit sales multiplied by 365. Then you calculate your average debtors. In this question, like, you are not given the average debtors directly, you have to calculate the average debtors. So to calculate the average in accounting, you take last year's figure plus this year's figure, then you divide by 2. So you will take 60,000 plus 50,000, you divide by 2, you will get 55,000. So this is the calculation highlighted in red. To calculate the average debtors, you take your last year's debtors divide by plus this year's debtors, then you divide by 2. So you'll get 55,000. This is the formula. Then your 55,000 like represents your average debtors. Then you take that 55,000, you divide it by 650,000. You multiply by 365 days to convert the answer into days. Then you'll get 30,88 days. So it means it takes you 30,88 days, or approximately 1 month, to collect money from your customers or debtors. So I think it's not bad, like you collect your money after a month, which is a good thing. So which means the business is liquid in this case. But when dealing with the debtors collection period ratio, you have to compare it with the creditors payment period. Let me show you how. So let's say it, like we just proved that it takes us 30,88 days to pay right, to collect money from our customers. Then let's say you calculate the creditors payment schedule, then you get 50 days as your answer. So it takes you 30 days to collect money from your customers, but then it also takes you like 50 days to pay your creditors. So it's a good thing because you can use the money you collect from your customers to pay your creditors or suppliers, because 30 days is less than 50 days. So the formula for your average creditors period like is given by average creditors divided by your cost of sales. No, I don't think this is the correct formula. Yeah, it is the right formula. Sorry, guys. It's the average creditors over your cost of sales multiplied by 365 over 1. So, but then note that it must be more days than debtors collection period. Yeah, if like it must be more days than debtors collection period. I mean here, like let's say we have 50,000, just not 50 days, sorry, 50 days to pay our creditors, but then here we have 30 days. So it's a good thing the business is liquid, because I said it must be more days than debtors collection period, so that like we can use our money for debtors from debtors to pay our creditors, which shows that the business is liquid. This is how you would compare the debtors collection period with the creditors payment period. So make sure that like always your answer for creditors payment period is more like or many days than your debtors collection period for you to be liquid, and vice versa. By vice versa I mean like if your creditors payment period was 20 days, then you compare 30 days with 20 days, it means it takes you 30 days to receive your money from customers, but then it also takes you 20 days to pay your creditors. So which money are you going to pay your creditors with? If you get like, if the payments are due in 20 days but then you receive your money after 30 days, so this is not a good thing. It means you cannot pay your short-term debts or short-term commitments. So in this case, the company is not liquid if your answer was 20, not 50. So I'm just changing the number of days to show the way you need to comment to get all the marks. So lastly we have our stock turnover. Our stock turnover, this is very easy. You just like average cost, no, you just take your cost of sales, then you divide by average trading stock. Like I showed you how to calculate the average in accounting. When you calculate the average, you just like, let's come here, you just take last year's figure plus this year's figure, then you divide by 2. Always when they say average, you take last year's figure plus this year's figure, then you divide by 2. Here they say average trading stock, it means you have to take trading stock for last year, you add it with the trading stock for this year, then you divide by 2. That's how you get the average. Even here with the like creditors payment period, it says average creditors, it means last year's creditors plus this year's creditors, then you divide by 2. That's how you get your average creditors or average trading stock. Then cost of sales is normal, I think it will be given. Even cost of sales here will also be given. So but then the stock turnover must be many times as possible. You have to change stock, because changing stock means like you are selling more. It means you are efficient when it comes to selling, because you are not keeping stock like for too long on your shelves. Imagine like if you only change stock once a year, so that's not a good thing. But if you can change stock maybe 9 times or 10 times per year, it means it's a good thing, because it shows that you are selling more, you are selling many times. So this ratio must always be, this indicator must always be higher. Maybe you must change 15 times, 14 times, not once or two times. And always like make sure you compare it with the last year's figure. Maybe compare the 2024 stock turnover with the 2025 stock turnover. If there's an improvement, it means it's a good thing. If there's no improvement, it's a bad thing, because you are not changing stock more than last year. So in accounting, we're looking for improvements. We want to see if we improved or not. So compare the stock turnover rate indicator with its last year's figure. So you can check the trend. Is it an improving trend or a declining trend? Thank you.